Welcome back to the second part of this video. Having explained what dollar cost averaging and what index funds are, I'll now go on to review the quick simulation that I've done comparing the returns of different stocks and index funds that I've chosen. So because I only started learning about investing at around this time last year, my simulation was on investments made from exactly a year ago till now, where I had theoretically invested $100 every month into these stocks for the last 12 months. For the US market, I've picked the S&P 500 and Apple and Amazon. And for the Hong Kong stock market, I've picked the Hang Seng Index and Tencent and Alibaba, since these stocks are the ones that have received a lot of hype recently in both US and Hong Kong. So here are the results, and these are the returns that I would have made if I had invested $100 in these companies for every month in the last 12 months. And to be clear, there are many different ways to calculate the return that you're getting from your investment portfolio, which can, depending on the method you use, drastically change the end value that you are getting out of your calculation. And for my example, I have calculated my returns based on the net gains that I've made on my total net worth. For example, if I had invested $1,200 over the course of last year and have ended up with $1,320 in the value of the stocks that I own now, my calculations would show 10% gain in my returns, because $120 over $1,200 is exactly 10%. And as you can see, for both stock markets, the returns from the index funds were actually very comparable to the returns from the individual stocks. And if we were to factor in the amount of risk that one might have to take on by putting 100% of their investment portfolio into one stock, the 27% gain that you are getting from the Apple stock may not be that much more worthwhile than the 23% gain that you are getting in the low-cost index fund. And because in reality, most people don't just put their whole investment portfolio into a single stock. If someone were to have invested equally into Apple and Amazon or Alibaba and Tencent, they would have actually gotten a lower absolute return as compared to if they had invested into their respective index funds. As I said earlier, 1 year is a very short investment time horizon to use when you're comparing the returns of different stocks, because most of us will probably be planning to be investing for a much longer time frame. Therefore, I had also performed the same simulation on the same stocks, with the simulations starting exactly 10 years ago, with $100 being invested every month. It is worthwhile noting that Alibaba wasn't actually listed until 2014, so the returns that are shown here are actually just the returns that you would have gotten if you started investing in Alibaba since 2014. Now, when we're looking at this, the gap in the returns between the individual stocks and their respective indices are getting very, very wide. But before you start making the conclusion that this means that investing in individual stocks is better, think about yourself from 10 years ago. Would you have had the guts to commit 100% of your stock investment portfolio into just one single stock for the next 10 years without ever having sold it once at all? In fact, I would think that most people in Hong Kong would have not even heard of Alibaba or Tencent 10 years ago. And outside of these very successful companies, there are also a lot of other big, well-established companies that have done really poorly over the same time period, which a lot of people didn't expect either, most notably the oil companies, especially now. And for the people who are looking down at the returns that are in the Hang Seng Index over the last 10 years, I think there is an interesting concept to introduce in relation to that, which is known as the law of gravity in the stock market, a concept that was first described, I think, by John Bogle as well, founder of the first ever index fund. And this concept slash theory is quite complex on its own, and I think it deserves its own video to be introduced. But basically, it states that different types of investments within the stock market will ultimately produce similar returns over an ultra long period of time, given that these stocks can survive for that long. My main point of this video isn't that people aren't able to identify the good companies from the bad companies. But the point that I would like to make is that most retail investors like us probably don't go into enough detail and don't put enough effort into doing enough research for a stock before they decide to invest into it. So even if a stock is able to do well in the long run, most people don't have that mental and psychological stamina to hold on to that stock and always end up selling at the worst possible time when everyone is filled with fear. This may have happened in late 2018 when Amazon incurred a 20% drop. And in order for its investors to be able to hold on to its stock and be able to eventually see it rise to the price that it is at today, they would have had to endure around 1.5 years of psychological torture without giving in and eventually selling the stock before they were able to see their stock reach new highs since September 2018. Also, I'd like to reiterate the risk that is associated with investing in companies, because a company's price can stay low for a very, very long time, whether it's because of their poor sales or poor management or poor product, but it is much less likely for a whole economy and whole stock market to be collapsed for an extended period of time. And if that is the case, I would think that we would have much bigger problems to deal with rather than just thinking about our investment portfolios. But before I end the video, I do want to make it clear that those who actually spend the time and effort into doing the research into learning how to invest may be able to actually beat these index funds, because with the greater amount of research to investigating a stock, they're able to strengthen their confidence in that company and therefore have an increased chance of being able to hold out through the bad times when the stock price is at a very low point. But because most people around me probably won't be spending that amount of time and effort into trying to perfect their craft in investing, I don't think we should be playing around with our life savings. I should also make it clear though that index funds are not a risk-free type of investment, just that it is the lowest type of risk amongst different options within the stock market. But there are other safer options outside and more prudent ways to manage your money other than just throwing it all into index funds. And you can still lose 100% of your money if you try to speculate with index funds as well. And to finish off this video, I would like to share a quote from the world's most famous investor, Warren Buffett. Rule number 1 of investing is to never lose money, and rule number 2 is to never forget rule number 1. The goal of investing is playing not to lose, because if you ever incur a loss of 50%, you would need 100% gain in the future just to get back to where you were before. So despite index funds not always being the most attractive or exciting option for us to invest in, it is important that we keep in mind this advice that comes from the world's best investor. So that's about it for this video. Again, this is just my own opinion, and I'm always proven wrong anyway, so thank you for watching this video, and I hope to see you next time.